adding listed real estate to the mix also gives you directional information. And what I mean by that is having or using the direct or public market signals. You can use these insights from the listed markets to help to steer also your private portfolios in the right direction. So it's access, it's quality, it's attractiveness, and it's directional information.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. In this week's episode, I'm speaking with Friso Berghuis, Director of Listed Investments at Dutch pension fund investment manager Bouwinvest. Friso is here to share his insights into how REITs and listed real estate fit into Bouwinvest's overall investment picture. Friso, welcome to the podcast.
Thanks for having me, Sarah.
First of all, can you give listeners some background into the types of clients that Bouwinvest serves and how your REIT and real estate investment strategy has developed over the years?
Yeah, sure. At Bouwinvest, we invest on behalf of pension funds, insurance companies, and charities. And we provide tailored investment solutions that serve the long-term interest of our clients' stakeholders. We're an all-round investor and invest in a wide range of real estate sectors globally. And we're a leading living investor in the Netherlands. And in the Netherlands, we manage assets on behalf of 35 investors. And internationally, our main topic for today, we exclusively work for BPF Bouw, which is the pension fund for the Dutch construction workers.
And for Bouwinvest, private and listed real estate are really seen through the same lens. Why has that been the case for you?
Yeah, that's a great question. And we've been running this mandates, this 3 regional mandates in Europe, North America, and Asia Pacific since 2010. And we have been executing on a fully integrated public and private solution since 2012. And essentially, it comes down to selecting either private or public markets and sectors on basis of 3 things. 1 is availability, 2 is quality, and 3 is attractiveness. Good examples of where we primarily choose for listed investments are, for example, healthcare in the US, self-storage in Europe, and data centers in APAC. That said, for us at Bouwinvest, it is one of the key phrases that is our starting point to execute on this integrated approach, in that we consider listed real estate as real estate. And for long-term investors like we are on behalf of the pension fund for the construction workers, listed is the same beast, just with another wrapper. And by adding listed real estate to the real estate mix, investors like the pension fund avoid ruling out specific compelling markets and sectors. And I just mentioned some examples like self-storage or healthcare or data centers, but our global allocation also includes geographic markets, where listed companies offer better access than private investments sometimes do. So examples of geographic areas are Canada, the Nordics, and Singapore. And this reason to invest globally via public as well was referring to access. But to us, it's not only access to specific markets and sectors. Essentially, investing in listed real estate means you are also adding high-quality, diversified portfolios to the mix. And these portfolios are generally managed by seasoned management teams. And we are aware of the fact that listed liquidity comes also with higher volatility. But when you adjust for the time lag, private and public, but also the volatility, we see that the correlation between private and public real estate investments is quite significant. Again, the prerequisite is a long-term horizon and local expertise, which really ties into why we work with local partners around the globe.
Yeah, that really works into my next question about the importance and role of local REIT investment managers in your overall strategy. And can you talk a little bit more about the regional markets that you're active in?
That's a nice segue indeed in how we work internationally, also for our public and private investments. As I mentioned, we have been executing on this integrated approach since 2012. And early on, we decided to team up with local investment partners for our listed investments. And the reason to do that is that we are convinced of the added value of having local boots on the ground. This is the case for our private investments, but also for public investments. So what then is our role as Bouwinvest, and what is the role of the investment partners? Essentially, by partnering and teaming up with the locally present like-minded investment managers we selected, we use a layered approach. In that approach, we select the markets and sectors we would like to get exposure to via the listed side in this case. And we decide how much to allocate to, for instance, US healthcare. And then this is a mini mandate or strategy, as you will, where our investment partner in the US or in North America has the discretion to invest in a predefined shortlist of healthcare companies that represent our strategy. So partnering with this local present REIT managers ensures local market expertise, and they have long-standing relationships and continuous dialogue with the management teams of the REITs we selected. And another benefit of working with these investment managers is they not only represent us, but also other investors, and therefore have more leverage on getting things done and also meeting our objectives, for instance, concerning ESG and related topics. And lastly, and that is our own flexibility, we are a real estate investor as within Bouwinvest. And if we would have all the trading and infrastructure in-house, that would mean a lot to us as a real estate investor. And so we chose to have more flexibility and select investment partners around the globe that do have this, for instance, in-house trading venues at hand. Your second question referred to which regional markets we're active in. Already mentioned that it's 3 regions. It's North America, Europe, and APAC. And the listed investments are an integral part of these 3 regional mandates. And in every region, we have around 8 listed strategies, like what I just mentioned, the healthcare in the US, but also office and retail in Singapore and in the Nordics in Europe. And we continuously monitoring the sizing of the listed strategies, and we actively make rebalancing decisions when it comes to investments and divestments. And we do not shy away from fully exiting a strategy or implementing new ones if we deem that good for the integral mandates.
And you've touched on this already, but which REIT sectors are the most compelling investment options for Bouwinvest today? And do you see a growing contribution from non-traditional real estate sectors?
To start off with the last question on the contribution from non-traditional sectors. And yes, this is a growing piece of the pie. And I dare to state that we have been shying away from the traditional sector food groups early on. And also to make a foray into sectors like self-storage, but also single-family rental in the US and also healthcare. And what we typically see is that the US is first. And why is the US first? When in our experience, they are ahead of the other regions when it comes to introducing new or niche sectors. So to us, that is very helpful to see, and if these niche new sectors also are likely to get traction in regions like Europe and APAC. And actually, in practice, they did. So we used the US as an example to implement similar new strategies in other regions as well. But also the US is directional when it comes to an early indicator or warning indicator to the downside. And the best example, I guess, is it's the retail sector really started to show less of a compelling story from 2014 onwards. And we also tried to apply that effect, which was largely driven by the upcoming e-commerce piece of the pie. We tried to apply that to the other regions as well and to really get to know if the consequences would be as big as they were in the US. We constantly try to navigate both opportunities and threats in our 3 regional mandates by using public market signals. So the most compelling sectors currently, that's quite a few, but I would mention 3. One is healthcare. It shouldn't be a surprise that the aging population, especially in Europe and also in the US, is a tailwind for this sector. And we see that economies of scale, they prevail in this sector. And there's some good examples in the listed sector that tie into this theme. Another one is what we recently been eyeing is, for instance, retail in Australia, which has several tailwinds. One is that e-commerce is not that big and is not expected to become as big in Australia. Supply-demand dynamics are very favorable, and we also see that operations are strong. Having said that, we are constantly comparing notes with also my colleagues on the private side, and we can do either public or private or do both, or decide not to have any exposure at all. It all depends on the combination of access, quality, and pricing. And for the listed portfolio, we might also change direction virtually overnight, given listed market movements, which are swift. And would like to end this question, Sarah, to rephrase Wayne Gretzky, the ice hockey legend. And he already rightly put it, skate to where the puck is going, not where it has been.
Good advice. And Friso, a complex subject, but one I'm sure you can explain, the upcoming changes to the Dutch pension system. Can you just give listeners a brief overview of what that entails and how that might influence your view of listed real estate?
That's a complex question indeed. And to start with my final conclusion, it remains to be seen for a large part. But effectively, pension funds will be divided into age cohorts in the Netherlands. And that enables greater portfolio risk taking for younger participants. And as a result, a higher allocation to illiquid investments such as real estate becomes possible for these groups. And the removal of capital requirements for illiquid investment reduces capital constraints and allow for more room in portfolios for illiquid assets, including real estate. Most industry-wide pension funds are opting for the solidarity contract. And within this structure, the negative impact of temporary illiquidity is more limited as liquidity risks are pooled. And this stands in contrast to individual contracts. In these individual contracts, each participant has a separate investment mix and would be more exposed to liquidity challenges. But having said that, it remains to be seen how quickly these opportunities will materialize, to be honest. And many allocation decisions we see that are still on hold, as the pension funds are currently focused on implementing the transition to the new pension contract. This transition demands caution and careful navigation. And the practical positioning of real estate within this new framework is still somewhat unclear and will only become evident once the system is put into practice. So, all in all, it's also fair to say that real estate will need to compete with other illiquid asset classes, such as private equity, infrastructure, and farmland, to gain its place in the institutional portfolios.
Apart from those upcoming changes, what are some other key themes or trends that you're watching closely with regard to how they might impact your REIT investment strategy going forward?
Yeah, it's macro themes like inflation, political elections, and tariffs, to give some examples. But the real problem is that these events generally have a limited predictability. With a great one virtually overnight or early this week. So the outcome in the elections in Japan, which was a surprise, and that also had an effect on REITs and real estate, listed real estate in general, and equities in Japan. But in this macro uncertainty, we try to identify both longer term, but also second order effects. So, for instance, we still have higher construction costs and therefore limited supply in various pockets of the market following interest rate rises in 2022. And we remain that to be elevated for longer term. On the other hand, we also see somewhat of rate cuts around the globe in certain markets. And we therefore anticipate or try to anticipate that housing markets pick up. And it's not only housing markets or the living sector that we then focused on, but it might also potentially lead to increased demand for self-storage, which is linked to housing market dynamics. So in that macro uncertainty and unpredictability, we try to navigate as well. And another topic is, and what is more predictable, as we will, is demographics. I already talked about healthcare. We see a longer-term tailwind given aging populations. That healthcare sector is very compelling, both on the listed and unlisted side. Best example here is in our integrated approach is healthcare in the US. We've been investing in this sector for quite some years on the listed side. We've had a tremendous run last year. Pricing is quite demanding currently, and now we have also the opportunity to invest via the private side. So we're slightly reducing our public investments and invest on the private side. So there you fully see that integrated approach into action. Another one is talking about the living sector and demographics, is that there's a housing shortage in virtually every market we are targeting. So for us, that still remains a longer-term thematic in our portfolios to see what pockets are really fulfilling the need and also give us the financial reward we're looking for. Besides demographics and macro, there's also capital markets movements we try to navigate. And for instance, there's generalist investors movements where public real estate investments have been on the sidelines for quite some time. It's just only a small sector in broader equities. So we really try to grasp whether that is picking up or not. Another one is the M&A and IPO activity, which has been muted, especially in Europe. We're constantly navigating if that's gaining traction as well. And another last one, which is a good example perhaps, is we have seen that past couple of years that we've been investing in Japan on the listed side, governance was lagging as compared to other regions. And over the recent years, we've been seeing quite some improvements on that front, which is closing the gap in pricing perspective, that is. Yeah, that's quite some topics we're constantly monitoring and try to also steer our portfolios towards.
Friso, you've shared lots of insights today. Anything else that we've missed?
I started off by saying that listed real estate is real estate, and I want to stress that. And perhaps to wrap up, I will highlight important factors why listed real estate benefits the real estate portfolio when investing around the globe. And one is access. By means of having listed market at your disposal, it means effectively you can swiftly invest in multiple sectors and markets, including niches. Second is quality. The high quality, diversified income producing portfolios are readily available on the listed side, and they're typically run by seasoned management teams. A third one is attractiveness. Listed and unlisted investments generally do not move in sync over the cycle. So in that differential in pricing, it also provides opportunities between listed and non-listed investments. So really, you can, as an investor, use that in your allocation and ultimately your bottom line results. And last but certainly not least, adding listed real estate to the mix also gives you directional information. And what I mean by that is having or using the direct or public market signals. You can use these insights from the listed markets to help to steer also your private portfolios in the right direction. So it's access, it's quality, it's attractiveness, and it's directional information.
Friso, thank you so much for your time with us today.
It was my pleasure, Sharon.
To our listeners, if you enjoyed this episode of the REIT Report, please subscribe or leave a review on your favorite podcast platform.